All right, hey everybody, welcome back to episode number 2. Jason,
2.
welcome back.
Yep.
Man,
Thanks for having me.
that first one, I'm not gonna lie, I was a little nervous about the audio situation that we had.
Yep.
So hopefully we don't have that ever again.
Well, I'd like to think we'll just get better and better as this thing progresses.
Better and better. One thing I did notice is I could put our names across the bottom this next time. So I think I'll do that on this video.
Okay.
So, man, we are stepping up in life. We're going to have name.
Big stuff.
Yeah. They're just going to come across the screen. They probably already have by now. So those of you who don't know, my name's Colt Callison, and I'm here with my co-host, Jason Emily. So we've been friends for quite a while.
Yep.
And, I'm excited about today's episode. So we're going to talk about the infinite banking concept.
Yep.
It was created by a gentleman named Nelson Nash years ago.
Yep.
Very smart guy. Studied Austrian economics.
Yep.
He was a forester by trade and everything. So he thought long term. You know, when you cut down some trees, they don't just go back right away. So very excited about that. Again, I just want to reiterate a quote that I came up with in the last, or didn't come up with it, but a quote that I mentioned in the last episode. So people know enough to believe that they are right, yet they don't know enough to know that they are wrong. So keep an open mind with this. This is going to turn off some people, and we get that. Hopefully, they'll stick around and kind of engage a little bit in this concept because it took me a couple of years to get on board with this. So I want you to introduce us to the infinite banking concept. What is it?
Okay. Well, so what it is you do not have to rely on the bank to finance your life. Right now, the majority of Americans go to the bank, whether it's purchasing a vehicle, purchasing their house, whatever it is, because they don't have a pool of funds already on hand to be able to take care of those purchases. And so the thought process is there is a point, and there could be a point in your life where you no longer have to go to the bank for any financing at all.
Yeah. So let's just throw this out there. We finance everything in life.
Everything.
Every single thing. You either pay interest on something that you buy.
Yep.
Or you give up interest. If we pay cash for something, you give up the future interest that you could have earned on that dollar.
Yes.
So essentially, you are financing everything. Every decision you make when it comes to money, you are financing, right? Most people choose to take the quick route, and I've done it before in the past many times, where you finance, let's say, a car, a home, or something like that, right? And you're paying interest on that money to the bank, who then gave you, the ability to buy the car, the house, whatever.
Yep.
Not saying that's evil by any means. We're just saying there's a better way. And with this concept, you have to build your capital, your stores of capital.
Yep.
You have to, what Nelson Nash called, capitalize your system. This is not going to happen overnight.
No.
This is going to take a while. Even I've been doing this for the last 2 years, and 2.5. And even if I would have kept everything in my system, every dollar in my system, I still wouldn't have enough to have paid cash for my house. So I still have a loan with the bank on my house. There will come a time where I will transfer that loan from the bank we currently have to our own banking system and then recoup all that interest. So I'll just read it straight off the Nelson Nash website. It's the infinite banking concept. It's a financial strategy that allows individuals to take control of their finances by using a specially designed whole life insurance policy. Oh my gosh, whole life? Whole life. That's a trigger word. It uses a whole life policy as a personal banking system. Rather than relying on traditional banks for loans and financing, infinite banking concept is about building a self-sustaining financial system where you recapture the interest that you are paying to the banks and the financial companies for the major items that you need in our lifetime. So you are going to have banking needs.
Yes.
Right? You're going to need access to capital.
Yes.
We all do, right? And so you're going to get that capital somewhere.
Yep.
And when you do receive capital, most people, like in the terms of their check, their paycheck or something, or they get an inheritance windfall, they need to be able to put that capital somewhere.
Yep.
Most people just put it in a bank account, right?
Yep.
And so with this, we're going to use the system for loans from a mutual insurance company using the insurance policy collateral, repaying policy loans on our own terms while the cash surrender value in the policy compounds uninterrupted, growing your wealth over time.
Yep.
Now, that's a lot.
Yep.
So let's break it down.
Yep.
Right? So it talked about using loans and paying them back on our own terms. What does that even mean?
Well, so going back to about financing everything, I think the one foundation that everybody needs to understand is, let's say the purchase price on a vehicle is $50,000.
Okay.
It's not going to just cost you $50,000. So if you pay cash for that, you may think it's only $50,000. However, the second you hand that cash over to GM, then pay cash for that, or the guy down the street that you bought the vehicle from, you've handed them $50,000 and you will never have that $50,000 inside of your hand ever again.
Yep.
That $50,000 could have been sitting, even if it was in a savings account, earning a measly 1% or less that they're paying you nowadays. At least it was earning some type of interest, right? And so just because you are paying cash with something, that's the opportunity loss that we're talking about, okay? If you go to GM, I'm just a GM guy.
Me too.
I guess, so I'll keep throwing out GM. But if we purchase that from a dealership for $50,000, it's not going to be $50,000 because GM's going to charge us interest on that. And now that vehicle over the course of 4 years, 7 years, 8 years, it's crazy what the loan out now in terms of time. But that $50,000 purchase may actually cost you closer to $65,000 or so when it's all said and done.
Yep.
So that's where we're coming back to this whole process. So if there's a way that now instead of paying that interest to GM Financial or Ameritrust Credit Union or Bank of America, wherever your banking needs are, now the thought is, well, what if I create my own pool of funds that I can use as collateral to borrow against? I'm sure we'll get into this in other episodes and such of using other people's money, right? Anybody that has grown substantial wealth always talks about using leverage, using other people's money to grow their wealth.
Yeah.
And so books that you've read, whether it's Rich Dad, Poor Dad, or all these other investment books, talk about other people's money. Well, if you created a pool of funds, AKA premiums that you pay into a life insurance contract that provides cash liquidity with the way that this is properly structured, that's important, and we'll get into that a little bit. But this pool of funds now continues to sit inside your whole life policy. And so when you take these loans, it is not your money that you are borrowing. You're using it as collateral to take a loan, and shows that as you take a loan from the insurance company, is I can pay that loan back 100% because I have cash value here that will pay off that loan if something happens to me. If I pass away or I'm not able to make that loan repayment, the cash value is sitting there just to pay that loan and it's gone. We are using it to borrow the insurance company's money, and we will pay interest for that. But the great thing is our cash stays inside our whole life policy and is also earning an interest while we're paying interest.
So it's kind of like I have a traditional savings account at the bank. And let's say this bank is an awesome bank and it pays me 5% on my savings account.
Okay.
That'd be awesome.
Yeah,
in
that'd
today's
be
world,
awesome, wouldn't it?
Right? Today's world. And I go to the bank and I say, hey, I have $50,000 sitting in my savings account. I want to take a loan out for $50,000.
Yep.
But I don't want to touch my money, right? Because you guys are paying me 5%. So I'm going to borrow the bank's money from their general fund,
Yep.
not touching my money, and then my money continues to grow forever,
Yep.
right? That's essentially how this is set up.
Yeah.
Because the life insurance companies, they have your cash value, right? It's sitting over there. That is a future paid up portion of your future death benefit, right? So that's the amount of money that grows extra above your base premium, right? The death benefit portion. And we'll talk about the differences between the base and paid up additions and cash value and all that kind of stuff later, right? But that money is setting aside over there, and we don't want to interrupt the compound interest. Time is on our side, and we want to utilize time as much as possible, because if we were to go to our bank, right, and we say, hey, we have $50,000 sitting in our savings account, instead of borrowing money, we want to just pull out our money, our $50,000. Now we've interrupted the compounding interest, and we will never get to see the true power of how that grows.
Exactly. So each time you interrupt, you are changing the end game, the end number, drastically. And so there's several scenarios I can show to clients and show that. Even if you pull that money out for 6 months or a year or something like that, but if you're talking about real estate or whatever it may be multiple years. And if you start to do the math and plug it into Excel sheets and all those type of things, to lose that compounding interest for even a year or two is drastic when we start to look 10 years, 15 years, 20 years down the line.
So why are we looking at a whole life insurance policy? Why can't we just do this in a savings account?
Well, so you think about that savings account. So you talked about 5%, which is not going to happen. Okay. So that's one reason, is the rate of return is much higher in terms of the dividends that these mutual insurance companies are paying. They are actually paying you a portion of the profit because you become an owner of that insurance company when you take out a policy with these carriers.
The life insurance company.
The life insurance company.
So this isn't with just any or insurance company like Allstate or State Farm or something like that?
No. So I am very, very selective with who I choose as the insurance carrier. Okay. I've got to see past performance. I've got to know that they've been profitable every single year, AKA will actually pay out a dividend. It has to be mutual in nature, because if it's a stock-owned company, the people that are making the decisions are the stockholders, and all they care about is whether or not they get their dividend or not, and if the insurance company is profitable. I hate to say this, but humans are humans, and they will base decisions on whether or not they're getting the paycheck. And if they're not going to get the paycheck and get their return, you may not be getting a dividend in a given year at a stock-owned insurance company. So you got to be very, very mindful with who you're going into business with, because this is a contract between you as the individual and the insurance company. And so you are contractually guaranteed certain instances. So you want to know who you're going into business with. Yep, for sure.
So we're looking for mutual insurance companies.
Yes.
All that really means is they're not owned by stockholders.
Exactly.
Right?
Yep.
They're private companies. And when you become a policy holder, you get a new policy. Let's say I take out a policy on myself, right? A whole life policy. I become a mutual owner in that company, right?
You get voting rights and all those things that you otherwise would not get.
So I want my company that I go into business with, that I become an owner with, I want them to make a profit. I want them to be profitable, right? Because
why would you have a business if it wasn't going to be profitable?
Exactly. and we want to make sure that when it comes time for them to have to pay out our death benefit whenever we pass, right? And our Nelson Nash calls it graduating.
Yes.
All right. He's a big Christian faith. And so we want our insurance company to make a profit, be profitable, so where they're strong financially and they can pay out their obligated death benefits.
Yep.
Right.
The difference here also compared to a savings account, and I've had people say, well, I could just do this with my savings account. So the uninterrupted interest is a big win here for using this strategy and using these products. 2 is you're paying tax on that 5% that you earned in your traditional savings account. And so now you're even interrupting the compounding on that regard too. On top of if I take the money out, but now I'm getting taxed on that 5%. So you could take the math, whatever your income is, whatever your taxable income is, so you may earn 5% on that, but if you're at a 25% tax bracket, you didn't earn 5% of that.
About 3.5.
Exactly. And so where inside here, the infinite banking policies is that growth that you got is tax-free.
So it's kind of like a Roth IRA.
Could be, yeah, in that aspect. I've had it compared to that quite a bit, but there's different nuances and such.
As far as that tax,
exactly,
structure.
Yeah, implications and things like that. Yep, for sure.
So, because a lot of people know that a Roth IRA grows tax-free. You fund it with pre-tax dollars.
Yep.
Right? Or not pre-tax, post-tax dollars, right? After you pay tax on your income, you fund it. Same thing here, right?
Exactly.
Pay taxes, and then with what I got left over, I can choose to do this or not, right? So,
So there's just those nuances that you need to know and why it's important to have a mutual insurance company.
I like it. Not that I'm looking to get sued or anything like that, but I like it from a legal protection. So that money, once I pay in that premium, it's no longer my money, right? It's the life insurance's money. It's the future death benefit that they use, and they're putting that money to work. It's a private contract, so it protects me from creditors, right? And so I really like that aspect of it as well. When it comes to infinite banking concept, the thing that I read in Nelson Nash's book, Becoming Your Own Banker, he talks about we live life with either headwinds or tailwinds, right? Headwind is in the financial world, you have a bunch of credit card debt, you have a bunch of student loans, you have a bunch of, car payment, interest, everything like that, high interest stuff. Let's say you're getting hit with 15, 18% rates on your car payments, you're getting hit with 24% rates on your interest. That is a lot of headwind that you're pushing up against to try to get ahead, right? So you need to pay those off and be strategic with that. You also could set up your own system where you have tailwinds, right? And then me being a pilot and everything, I love tailwinds because my airplane could fly through the air at 150 knots, right? But if I have another 50 knot tailwind, pushing me, I'm no longer flying. I'm still flying through the air at 150, but I'm flying above the ground at 200, right? Because I got that extra wind, that extra push. This system allows me to recapture all that interest that I was paying to banks on car loans, insurance, or not insurance, credit cards, everything like that. Now I'm financing it, and I'm paying myself that interest, which is going to expand my banking system even more.
Exactly. So you could think of it also as an airplane taking off. The amount of fuel that it takes to get this thing going. But once you're up to altitude, you're cruising at that point. And so this thought process is the exact same way. Is you need to get this funded. But once you're at a takeoff stage, you are starting to coast in that regard. You're not having to burn as much fuel in that regard. So that's another way to take a pilot type analogy on this as well.
Well, and Nelson Nash talks about you should never be afraid to capitalize your system, your banking system. And for the longest time, I have to admit that didn't make any sense to me, because most people will take a look at a premium payment, let's say $1,000 a month premium payment for insurance, and they look at that as an expense, right? And that's very hard to overcome. I'm not going to lie. And then when you throw on, I got 6 policies, and I'm funding all 6 of them, and they're not just $1,000, right? They're quite a bit. What it takes is, and this is why I started tracking it, I can see every month from month to month how much in cash value we've built up, where we're at. I can look back over the last 2 years and tell you exactly where we were, right? What the cool thing is let's say I put $1,000 into my premium every month. I have access to a portion of that almost immediately. I mean, it takes, I think with the company I'm with, they want 15 days. But other than that, after that, I can access a majority of those funds. So talk about that just a little bit.
So in a traditional way that maybe a life insurance agent would fund a policy in terms of premium, that entire premium is going towards a death benefit at the time of your passing. And so they're looking at it as a different way to structure these policies than I would, because what I'm trying to do is create a living benefit. I'm trying to create cash accessibility to be able to take over the banking function and the financing of our life. So that $1,000, for example, that we're depositing into that policy, I'm giving actually a majority of that in cash accessibility on day one. It's buying up additional insurance. It's called a paid up additional rider, but I'm allowing that cash accessibility. Now, the cool thing is that one of the carriers that I use is only 5 hours away. So literally, if it came down to where I needed a check that day, I could drive up and have a check in hand the exact same day if it came down to that. But the goal would be is with anybody is, you get in trouble when you don't have any margin in your life. And so you're stressed to the gills and you have to have it today. That's when you start making poor financial decisions. So in this thought process is converting some of your cash, having a strategic savings plan, a structured savings plan, a forced savings plan, however you want to set that up, and creating this opportunity fund is what we're trying to help people do.
Yeah.
Yep. To be able to eventually take over those financing things at a much lower interest rate than the 8% for a car loan or the 15% for whatever it may be, and eventually be able to take that in-house and start earning that interest. Because there was a study not too long ago, but for every dollar earned, we are paying 34 cents on that dollar in interest
Just out
as
interest.
Americans now. Because when you talk about a headwind, if 34 cents on every single dollar you earn is automatically going into somebody else's hands, good luck trying to overcome that
And
at
that's
some
just
point.
interest. That's not
And that's
paying
just
down the
interest.
principal.
Yeah. So if we can then be able to recapture some of that 34%, you're going to change somebody's financial future forever.
And again, this doesn't happen overnight.
No.
I mean, this doesn't. So, my truck, right?
Mm-hmm.
Big GM guy, bought a nice AT4,
Yep.
right? That's a $75,000 truck. It doesn't just happen for somebody overnight.
Yep.
It might take you 2, 3, 4, 5 years to fully fund. I wouldn't say fully fund, but capitalize your banking system.
Yep.
Right? It's no different than if I was to go into business. Let's say I want to start a lawn care service, right? Do I start day one, no tools, no nothing? I can't go provide a service. I have to invest and buy equipment, right? I have to buy a truck. I have to buy a trailer. I have to buy a mower, weed eater. I have to invest money. So I have to come up with funds and invest in my own business, right? Now, some people shortcut that and they finance their equipment and everything like that. Again, the whole purpose of this is to try to take over the banking functions in our life and recoup all that and create that headwind or tailwind for us, right?
Yes.
And so let's say I'm going to invest, into my system for 4 or 5 years, and then I'm able to take over and that next car that I'm looking at, instead of paying the bank interest on that money, then I'm able to utilize this system. So, the process is pretty easy. I just looked it up on their website, and it's really a 5-step process, and we'll kind of break down each one of them. So step one is you start with a dividend-paying whole life insurance policy. Again, we're not looking at Allstate, State Farm, these stock. Basically, if it's on the Wall Street ticker, it's not the company for us.
Yeah, exactly.
Right? So we want mutually funded, member-owned, dividend-paying whole life insurance companies. And you're right. These companies that we work with, they are paying dividends for over 100 years, 150. They've never missed a dividend paying. And let's just, I want to hit this now while we're here. The dividend is not extra. The dividend is not guaranteed, right? Really what the dividend is the profitability of the company. They are refunding a portion of what they allocated for your base premium, right? So you overfunded and everything. And again, your company, your mutual company, made a profit. It's a great thing. And they gave you a portion of that profit back, right?
Exactly.
That's what that is. So these policies, you can have an illustration created, and it shows you the guaranteed rate, and it shows you what to expect if the dividends pay out. But from what I know about it, those illustrations are about worthless the day after the policy begins, because we don't know what the dividend will be paid. We don't know what the profitability will be like. We don't know if other things happen in the economy and something happens. So,
but even on that side, the guaranteed side, there are guaranteed growth built into those policies, even if the dollar would go flat for the rest of your life. So if you pass away at 90 years old and the dollar goes zero and the stock market goes zero for the next 50 years, in my example, if I die at 90, I am still guaranteed to have a guaranteed rate of return for the rest of my life. And you aren't going to get that anywhere else. So that's important. And so there's nuances with that. And, I would argue is finding a non-captive agent would be key to where they're not pigeonholed with what type of product they could share with you or something based on only one insurance carrier.
Yeah.
And so it's neat to look at all the different carriers because they're all competing for different markets and things like that to where you want to find who has the best product, who's a mutually based insurance company, and who has the best product for this concept at that time. Okay. That's step one.
Yeah, step one. And again, it's a whole life policy. It's not term. Term is we rent our insurance.
Yes.
Right? And ironically, if you look at the statistics behind it, only 2% of term policies even pay out.
Yes.
98% of term policies expire.
Yep.
And they never pay out anything. So I believe we had a conversation a while back where you're like, hey, that profitability of the insurance company, most of that profit comes from expiring term policies.
A lot of it does.
So just know the difference is whole life, it's a guaranteed policy forever, right? And that's the reason why you're paying on it for as long as you do. But term, you're only paying on it for a portion of time, and hopefully you don't die during that. And which is why 98% of them expire.
Yep.
So
there's a cost of insurance. The insurance company is going to be profitable. They're going to protect themselves, and they charge accordingly in that regard. So it's guaranteed that they'll have a payout at the end of a whole life policy, and the cost of insurance is spread across 121 years until that policy expires, and then they'll pay you what your death benefit would be. If you graduate that contract and live to be 121, you'll get a great tax-free windfall. But they charge accordingly across those 121 years.
All right, so let's talk about the second step.
Yep.
Build cash value. So each time you make a premium payment, right, you're paying in monthly or quarterly or, annually.
Yep.
I pay monthly on all mine. It's just easier that way, for me at least. So every time I pay in, a portion of that payment goes to the death benefit, but a large portion of that goes to what's called cash value.
Yes.
Right? And so we want to build up that cash value.
Yep. And you get to dictate how quick and how fast that happens in terms of taking over all the finances. So have individuals that put away a couple $100s a month in a premium, or you could look at this now as a deposit if we're going to start equating this to creating your own bank. And so looking at your premiums as a deposit, a couple $100s a month, or I know and have clients that are putting $100,000 plus a year into these policies. And so it's in relation to what you're comfortable with, what you can do, looking at your finances. Those are all things that we do. If you'd come to us and allow us to show you this thought process. So it all depends on, but the biggest thing is what you're comfortable with and how fast do you want to fund your system.
Yeah. So the way I started looking at it is kind of like a mortgage. Okay, I just want to clarify a big misnomer out there. This policy is not an investment. It's just not.
True.
Right? So an investment by definition could lose value.
Yes.
And go down, right? And this is not an investment. So whenever somebody says, well, whole life policy is a bad investment, absolutely.
Yeah.
Because it's not, right? And so what we do with that cash value later is the actual investment.
Yes.
Right? So, but I say all that because I want to premise with, I look at this as, okay, it's kind of like a mortgage, right? Every time I make a mortgage payment, it's kind of like a reverse mortgage, but not really reverse. Every time I make a mortgage payment, a small portion of that builds me equity. A large portion of that pays interest to the bank, right? But in this, a very small portion of my premium goes to the insurance company. A very large portion builds up equity, right? So it's kind of like a mortgage payment that's been paying on for a long time because every payment, every year, my account gets more efficient and I'm making more and more goes to the cash value and less towards the death benefit. So I look at this as building up equity just like if I bought a property. And then, so that's how I've been able to justify it in my head. Okay. Is just look at it that way. And then, again, tracking it, I can see how much cash value I got. So that's just how I go about it.
Okay.
So number 3, borrow against the cash value. So once we've built up a large pool of capital, again, your capital's got to reside somewhere. Are you keeping it in a bank account, in a savings account, or are you keeping it in your own system, right? Which I like my own system because it provides a good death benefit on me. So if I happen to die, my family are well taken care of.
Yes.
Right? And then I'm also storing capital that can't be touched by any creditor or anything like that. It's guaranteed to go up in value. There's just so many benefits to it, right? And I still have access to it, right? So once we build that up, we're going to then start taking out what's called policy loans, right? We don't want to withdraw that, right? That's different. We want to take out policy loans. So then we're going to the insurance company and we're saying, hey, I have $50,000 over here. I need $25,000 for this car. I don't even have to tell them what I'm using it for, which is kind of crazy, right?
It's awesome.
When you go, you've taken out a policy loan.
I have.
Right?
A time or two.
A time or two. Did they run your credit?
No.
They didn't. Man,
no.
That's crazy. Did they make you fill out a whole bunch of questionnaires on, all your life story? And did they need your tax returns?
No.
So they didn't ask for any of that.
No.
Right? What are the two questions they typically ask you?
It's Mr. Emily, how much and where do you want it?
How much and where do you want it sent?
And what dictates the how much is there is a ceiling. It's how much cash value do I have?
Yep.
So that's the only stipulation. So if you have $50 in cash value, you can only take a loan for $50. Or if you have $500,000 in cash value, you can take a loan up to $500,000.
And it's typically, at least every time I've done it, it's typically in my bank account within 48 hours.
Yep.
So every now and then we have problems, but those are few and far in between, and they're getting it kind of settled out.
Yep.
Just remember, insurance companies are not banks.
Yep.
They don't have online banking where I just fill it out and it's a ACH right away. So they're still a little old school, and I wish they would kind of get up with the times, but it is what it is.
Well, and that's something partnering with insurance companies and working with them is they're coming along. They really are, because this infinite banking concept is really starting to catch wind. People are realizing, and we talked about this last episode, that what they're doing just isn't working. And so they're seeking out and they're finding different ways to create velocity in their money. And the infinite banking concept is one of those ways to create those tailwinds and make your dollars go further and faster and all those type of things, and creating velocity. And so insurance companies are realizing people are coming to me and they're wanting to take in this concept. And so we better get on the train also, or somebody else, another carrier, is going to want to start servicing these policy owners. So they are growing and they are learning. And I guess kind of toot our own horn is our firm is helping with a lot of that as well, to help them understand really what they are capable of doing.
Yeah, because the insurance companies didn't come up with the infinite banking concept.
No.
So
our Nelson Nash came up with the concept.
Yeah.
So in realizing that, hey, I can use this as collateral, I can borrow against this. And I don't know if we want to go into that subject, but he was forced into looking at this as a concept and a way to get out of his financial troubles. And we are the beneficiaries now of, unfortunately, the financial struggle that he had in the early 80s. But an insurance company did not come up with this concept at all.
Yeah. So when I'm looking at taking out a policy loan, right, for one, my policy loan, like you said, you can only take out as much as what's in cash value.
Yes.
Right? And remember, that policy loan is from the insurance company's general fund.
Yes.
Right? It's their money. You're not borrowing your own money. So when Dave Ramsey says, "Oh, I don't understand why you pay interest to borrow your own money. That's just stupid," right?
Yep.
He doesn't understand the process.
Yeah.
Or he maybe understands, but it goes against his teaching.
Correct. I'd like to give anybody and everybody the benefit of the doubt that he just isn't educated and he's giving his opinion without actually researching. But there's a lot of those times I'll listen to some of his interviews online or whatever it is, and he's saying something, and I'm like, that's not true. That one's not true either.
Yep.
Now, if that was true, then I could see where you wouldn't like this process. But a lot of what he talks about in terms of whole life is not true.
Yeah.
So I like to think that he's just not educated.
So I am going to pay an interest amount.
Yes.
And those are already predefined in the contract we sign when we do the when we start the policy.
Exactly.
Right. So I know what my interest rate's going to be. Right. So the only time I'd want to go borrow from my policy or from the insurance company and collateralize it against my policy. The only time I'd want to do that is if I can borrow money at a cheaper value than what I can in the marketplace.
Yes.
Right? So when home loans were 2.875, it makes no sense for me to borrow against my own system. Maybe it could, right? Because of other things where I get to dictate the terms of when I pay it back.
Exactly.
That's a big deal. If I miss a payment, I don't get hit on my credit, all that kind of stuff. So there's a lot that goes into it. But I'm just saying from a strict financial numbers, maybe it's not worth borrowing my own or against my own money, right, at 5% when I can get it for 3%.
Yep.
That might be the case. But most of the time for a car, I mean, interest rates right now, as the time of this, are like 8, some are 9, 10. It does make sense, right? Because I'm able to do that. Now, here's the other caveat to that. If I'm willing to pay a bank 8, 9, 10% for that car loan, and I'm going to make that payment anyway, why would I not then pay myself at least that amount of interest as well?
Yep.
So if I'm borrowing from the insurance company at 5, why would I only pay back 5? Why would I not be my own banker and do banking correctly at the current rates of the day and charge myself that 8, 9, or 10, just like I would pay any bank?
Yeah.
Why would I not do that?
Yeah. Your cash flow is the same if that's your thought process of what it would be if you went outside your banking system.
Yep.
So, and I would argue if you wouldn't be able to make that 8% back into your own banking system, you shouldn't be making it to GM Financial or whoever else it may be. That's my argument there.
Yeah. So let's talk about step 4, repaying that loan. So when you take out a loan from the insurance company that issued the policy, you get to set your repayment terms. I kind of touched on that.
Yeah.
So explain that one.
Yeah. So if you go to the traditional route in terms of lending, the lender gets to dictate what your monthly payment's going to be. They're going to dictate what your interest is on a monthly, annual, whatever basis it is. They're also going to dictate that if you do not make a repayment, that they may even come down with a wrecker and repossess the vehicle or take the collateral, right, that you have to take that loan. The only collateral that you have is your cash value, because that's what we put up for the loan collateral. You get to dictate any repayment terms. And so you can make extra payments, prepayments, you can make lower payments. I tell all of our clients that you need to be a good banker. And so we can share these in different episodes of how people have used this to finance. But whatever your payment was going to be to GM Financial or the mortgage company or whatever you're purchasing, I would argue make that same payment and some back into your banking system.
Yeah.
But the great thing is here, and why investors and self-employed individuals, business owners love this thought process, is I know that there's lean months in your business or in your, if you're a real estate investor and 3 people didn't pay their rent check that month, is it may be a little bit of a struggle to make that $1,500 payment back to your whole life policy.
Yeah.
Instead of, if you don't make that $1,500 check back to the mortgage company, they're going to start knocking on your door and wanting that house. Where here is if somebody didn't pay the rent, you could choose not to make a loan repayment that given month. But this is the caveat, is knowing that at the end of the year, that interest is still due.
Yeah.
Okay. So there are a lot of options there when it comes to that. So there may be a month that a week after rent's due, they do make that loan repayment. Okay. Well, I'll just make the loan repayment, on the 8th day instead of the 1st.
Yeah.
And so that's why a lot of people love this thought process too.
I can tell you what, just being open and honest, from a guy that's had a car repossessed, the flexibility that I have with this, and knowing that if we for some reason have a lower income month and we choose to not pay that's peace of mind that comes with that. And knowing that if I do miss that payment, the insurance company doesn't care. Yep. And the reason why they don't care is if I die, they just take it off whatever loans I have out. They just take it off the death benefit payout, right? So it's collateralized against the death benefit. Yep. And so they don't care whether you ever pay it back or not, because it's going to be settled at some point.
Yes.
So, but that means, the world to me for just the flexibility. Now, it is good to be a good steward and a good banker.
Yes.
And set up the same terms that you would with a traditional bank. Just make them to yourself and be the bank.
Yep.
Right. So I don't know if most people know how banks get paid, but they don't use their own money to make money. They use your money that you put in the bank, and then they loan that out to other people.
Exactly.
And the spread on that is called banking arbitrage, right? And that if they borrow your money, right, by taking deposits, right, and securing your money, which isn't secured by anything, but whatever. If they take in and they pay you 1%, and then they loan it out to somebody else at 5%, they're making the spread. And everybody thinks, well, that's a 4% rate of return. And they are way off.
Exactly.
Because if they pay 1%, let's say $1,000. What's 1% of 1,000? $10? And they pay 5%, or they get paid 5%. 5% of $1,000 is what, 50?
50.
So I made 50, but it only cost me 10 in my investment. That is a 500% rate of return.
There's a reason why the banks have all the big buildings in
They got
town.
the biggest buildings in town.
Exactly.
Right?
And if we can shave off a portion of that and start bringing that in-house, game changer.
Yep, absolutely. So that's step 4, repay the loan. It's completely at your schedule. You dictate the terms. You are the banker. If it's, hey, I'm going to make a payment biannually, right? Whatever. If I'm only going to make an annual payment, whatever. You dictate.
Interest only payment. However, I mean, business owners love that thought process when you're starting a business.
So I work with a lot of real estate investors. How cool would it be, instead of going to the bank to fund your next flip, how cool would it be to fund your own flip, and you don't have to make a payment back to yourself until that flip is done?
Yeah, 90 days, 120 days. If you don't want to make a payment, don't.
Yeah.
And then when you sell that flip and you have the profits, then you can repay the loan.
You just
or
repay
keep
it.
the money out and roll it right back into another flip, which I think is step 5 here. Repeat the process.
Yeah, you're just repeating the process.
Yeah. So, for example, we finance our vehicles through this process. And so, we purchase a vehicle. Eventually, that vehicle is going to need to be replaced because we're putting miles on it. We've got 3 kiddos at home, and my wife homeschools, and we're running around everywhere. It's amazing the amount of miles we put on our vehicles. And so at some point, that vehicle is going to need replaced. Well, what if we could just recycle the same money that we purchased that vehicle 5, 6, 8 years prior? And that's exactly what we're doing. So as we're replenishing that cash value, AKA making loan repayments to replenish the bucket, that money is still there, still growing. And in 6 years, that cash value will be higher than what it would have been in a traditional savings account. Now, when we've repaid those loans, replenished the cash value, we can borrow against it again and go purchase another vehicle. That's just one example, but you could do that in real estate,
And you still
whatever
have the
other
trade-in value of the vehicle.
And you still have the trade-in value of the vehicle. Yes, exactly.
So I was thinking about traditional loans the other day, and like a traditional car loan, and just thinking about, I just kind of did the math on my truck, right? So a traditional loan on my truck would be about $1,300 a month, right? So you take so many hits when you do traditional financing through a bank. Not only did I lose value on the truck as soon as I drove it off the lot, right? So it's just over a year old. And I was looking at another vehicle, and they only wanted to give me $57,000. I told them they were full of crap, but whatever. But they only wanted to give me $57,000. I bought it for $75,000 a little over a year ago. So I've already lost $18,000, right? That's money that's gone forever. Right. But also, that $1,300 a month in car payments for the last 14 months, that adds up. Right. And that's money I'll never get back. Right. So if we were making that payment back to our own policy, at least those payments I get to recoup, and I actually have that in hand available to me the next time around. But traditional, I'll never have that money again. So I take the $15,000 or the $18,000 loss on the value, which you're going to take anyway, and I take the loss on how many payments I've paid out. And then the only thing I get is, okay, where am I at in the loan and how much equity, right? So I get to add that back. But still, the majority of that money is gone. So,
exactly.
Yeah. So basically, a couple things that I want to reiterate. We finance every single thing that we do. We're either borrowing money and paying interest, or giving up the ability to compound our money for the rest of our life. We choose, and you got me going on it, we chose a path created by our Nelson Nash in Becoming Your Own Banker. It's a great book, by the way. It's only 92 pages. I read it in a day and a half. highly recommend it.
Exactly.
Link in the description. Promise you,
Yep.
I will say that almost every episode.
Yep.
And we'll talk more than just infinite banking for those that are listening. But I can't get over the fact that we chose a path that allows us to build wealth, never interrupt the compounding interest of that wealth. And no matter if we borrow or not. The cool thing is, the longer these policies go, the more efficient they get.
Yep.
And there will come a time where I will put in a very small portion for premium because I cannot do additional paid up additions for cash value. But the policies are growing at such a rate that my internal rate of return is outstanding.
Yes.
And then I can borrow against it. And then even the year later, if I don't pay it back, it's going to grow again and I can borrow against it. So when you talk, I'm not saying it's the ultimate retirement account, but you could use this to supplement retirement.
You could.
Or you could just leave it in there, do what we're going to talk about on this podcast, buy other cash producing assets that, are passive income opportunities and become financially free and financially independent by generating enough passive income outside of this.
Yes.
I go on and on because just the benefits alone, it's changed our lives. Because before this, we made great money. Like we did good and we didn't have much to show for it. And now we have stuff to show for it. And now we're doing strategies where we're taking money out of this and we're doing policy loans and putting that money into investments that spin off of passive income that then pays back our policy loan, and it's a loop.
Yep.
Right? So it's like you said, velocity of money. You want to keep your money in motion at all times.
Yep.
So anything you want to end with on this?
Maybe the last thought is money is a lot like water, and anytime it gets stagnant, it's not healthy anymore to drink. And so, you got to keep money flowing.
Yep.
If not, it gets stagnant, it starts to stink, and stuff's going to grow in it. All of that, it's no longer in use. And so you've really got to get money moving. And so that's a thought that I'll leave with everybody on that.
Have you ever read the book Richest Man in Babylon?
Yes.
Great book.
Yep.
Love that book. And I love what he says. He goes, money loves a master that puts it to work. It does not love a master. It will go find a new master if you do not put your money to work. And so if you're just hoarding your money and you're keeping it there because you think that's the traditional way that a lot of baby boomers think. We just got to save our money, save, hoard. And my parents are that way, right? Not so much. My dad lost my dad last year, so not so much him anymore. But my mom, she will not go and buy investment properties. She will not go and do this because she thinks if she's letting go of her money, it's just gone, right? And she just doesn't see the power of that cycle. So hopefully she'll come around one of these days. But
last episode we shared that the numbers ain't working.
The numbers aren't working. Yeah, absolutely. So hey, if you like what you hear today, leave us a comment, like it, man, just thumbs up.
Yeah, right? Simple share would be huge too.
Yeah, share it.
Let other people know about this.
And above all, subscribe. We want to build this channel. We want to get it out, and a lot of people hear it. So. Also, if you want to talk to us, go to the website, wealthwithoutstress.com, and somewhere on the website there's a contact us or something. So reach out to us if you want to talk about this more in detail, one-on-one. So wealthwithoutstress.com. And until next time, Jason, thanks for being here.
No problem. I always enjoy it.
All right. We'll see you guys.